I will say that folks are getting a little bit more optimistic. Finally got our first round of rate cuts, which was great, but obviously hasn't translated to a positive impact on the 10-year, which has been a little bit of a stressful situation for us. And so we're seeing really compelling opportunities where governments are stepping in and creating proper incentive programs, because I think people have finally realized that, yeah, you can say developers are greedy all you want, but if there's no economic incentive to do a deal, a developer's never going to be able to raise the capital to create more housing supply. They're doing a really good job of incentivizing developers to take some of these really cool old buildings and turn them into housing, but it does cost a lot of money. Just like California, I mean, with wildfires and things like that, there's definitely a lot of climate and environmental risk being in Florida. I mean, when we look at a deal, your two largest expenses right now are taxes and insurance.
And we are live again. Hello, everyone, and welcome to another episode of the Multifamily Hangout. I'm your host, Adrian Danila, and I want to start by thanking our sponsors and our friends from Kairos and coastal painting contractors. I want to turn it over to my co-host, Chris Moreno, to introduce our special guest today. Take it away, sir.
Awesome. And I'll make sure I'm on the road too, Adrian. I'll make sure to hit mute when I'm not talking, because I know there's some background noise for all of us where we're at. Tyler Epps, who's joining us today, is out of the fund's Atlanta office, leading ASREF's Originations and underwriting asset management. Tyler's got a ton of experience. He's been at multiple companies in real estate, overseeing more than $1 billion of commercial real estate across the U.S., various investment funds. And his responsibility has been across all types of asset management, from hotels to retail, so much multifamily, but industrial and office too. So I think now, Tyler, I think you mentioned you've overseen over $3 billion of assets, but also you are a graduate from here in Georgia, right? So two universities, is that right? Georgia State and Georgia Tech?
Georgia State undergrad, Georgia Tech for my MBA. That's right.
Awesome. Well, thanks for joining us. We're so happy to have you today. And I think what's really exciting, we were talking about the growth potential, but to where you are today of doing billions and billions of dollars of management, overseeing, teams. Can you take me back to how you got into real estate? Was it something you had planned for, or was it something you kind of fell into?
Yeah, that's a great question. So thanks for having me, guys. I really appreciate it. So yeah, it's interesting. So I actually, when I was at Georgia State, I was an undergrad in finance in the business school. And honestly, it came from small town, grew up in Dalton, Georgia, and really had no concept of what real estate was outside of, traditional residential real estate. And so I was trying my hardest to get into the investment banking world, really enjoyed my time at Georgia State. Got an internship with kind of a financial planning group and ultimately ended up going that route out of undergrad. It was a very small shop. I had a really good job with that small shop, but it was kind of more, bootstrapped startup type group, didn't have benefits. And believe it or not, my wife got pregnant. And, it was one of those things of like scrambling, what am I going to do? I need health insurance. We're going to have to figure this thing out. And a buddy of mine from Georgia State actually reached out and said, hey, this group that, one of my mom's best friends works at called Tremont, they're in real estate finance and, they really need some help. And I think you'd be a great fit. And I said, well, I don't know anything about real estate. And he said, trust me, you'll be fine. I'll give you a crash course over, 2 or 3 weeks. You're going to ace this interview. And kind of the rest is history. So I realized probably within 3 months of being at Tremont that looking at the finance side of commercial and multifamily real estate was infinitely more exciting than, valuing stocks and bonds and things like that. So that's kind of how I just slipped into it.
Taylor, what are the main challenges when you oversee $3 billion worth of real estate? What are some challenges, and also what are some opportunities? I'm thinking there's a lot to leverage when you oversee such a significant portfolio.
I think it's important to note that's kind of been over my career, right? But I will say, while I was at Tremont, the lowest cog in the wheel, so to speak, right? The low man on the totem pole. Our portfolios, and I'm sure it's still this way for current Tremont employees, as an analyst, our portfolios were massive, right? I probably had 80 to 100 deals that I was the analyst on at any one time while I was there. Fortunately for me at that time, those assets were very well-performing assets. I was in the mid-20 teens. These were Class A luxury deals in San Francisco, LA, New York, primarily Miami, markets like that. I did kind of what our role at Trimont was really overseeing those assets on behalf of, lenders. So think pension funds, think big, massive funds, banks. I could name a bunch of names that everybody that's tuning in would know, kind of every household name. And our job is really to be the first line of defense, track budgets, see how properties are comparing to the budget and things like that, track construction progress, and then really ultimately report it up to the banks or funds. It was a lot. It was definitely a lot of things that we saw. For instance, I worked on the 432 Park Avenue project, which is in the news all the time now for, construction defects that we certainly did not see, during the construction of that asset, but it's a tiny, very small rectangular building that's on a tiny footprint in New York City. So building as tall as it was, it's on the skyline in billions and every big financial show you see set in New York. But I think, it was a really good experience to see a lot of performing assets, because when I left Trimont, I went to Rialto Capital, which everybody, at least in the South, knows Rialto as the group that bought a lot of foreclosure portfolios off of banks' balance sheets during the Great Financial Crisis. And so when I stepped in there, I had a massive portfolio of troubled assets across the South, retail repositionings, hotels, office buildings, things like that we really had to invest significant capital into to be able to kind of get those things in a position to sell and off of our fund's balance sheet. And so it went from seeing the best of the best in only the best markets to kind of seeing more troubled assets across primarily the South when I started. Now, after, call it a year and a half or 2 years, I transitioned as we had sold off that REO portfolio, transitioned over to the CMBS special servicing team, managing the deals that were in special servicing that had either been taken over by the CMBS pool or were kind of in receivership or something like that. And so it was always troubled assets at Rialto. And I got a really good sense of kind of the things that can make deals go sideways. We saw it a lot in the underwriting process, even when we were buying CMBS pools or the B piece on CMBS pools. We were underwriting hundreds of deals every month. Just tons and tons of deals. And one of the things that we really focused on during that time was how much skin in the game sponsors are going to have, after they had refinanced into a CMBS loan. And, typically what we saw is those deals that went into special servicing. The sponsor either had a very significant or in some situations, a total cash out refi. And, they were very willing to hand over the keys on some of those deals. And I think that's definitely followed through with how I look at and how our team looks at, any equity investment opportunities we have on this fund, is making sure our sponsor partners have significant skin in the game, and we're both duly incented to have an asset perform through to an exit.
Before, as we were prepping for the call, you talked about different types of partnerships, and you don't have to name any names, but we think about partnerships that could be other investors, that could be LPs, that could be merge with and acquire properties through. It could be management companies, and it could be technology partners. How do you think about managing all of these different relationships? And, maybe things you've learned over time being a leader and making decisions, and maybe the culture that you tell your teams of how to think about those relationships together?
Yeah, it's a really interesting question. We, at this fund, so at American South Capital Partners and through our American South Real Estate family of funds, we've always been kind of very small, and we really pride ourselves on being nimble. And one of the things that we like to preach to the groups that we're working with is, hey, we want to be the best partner you've ever had, right? And that kind of flows through, and we have the same expectation of the partners that we work with, right? So hey, we're going to be diligent on the front end. We're going to make sure, everything checks all the boxes. We want communication lines to be open. We'll answer a call at any time, and we kind of expect the same thing. We truly do want to be passive equity, right? We don't want to manage these deals on behalf of our partners, but we certainly have the capabilities to do so if needed. But I think a lot of that flows through from the leadership of the companies that, are the co-GPs of our fund. So to give some background, our firm was founded by two different groups, a group called Vintage Realty Company that's based in Shreveport, Louisiana, really family owned and operated full service real estate shop. They do ground up Class A multifamily development, brokerage, property management, and then they also have commercial side where they do development, brokerage, leasing, and then they've also got management, but then they've also got single family home group. I mean, it's a 200 plus person company that still feels and is really a family company. And then the other partner on the fund is a group called SDS Capital Group out of Los Angeles. That's one of the really premier impact fund managers in the nation. They're regularly ranked in the Impact Assets top 50, impact fund managers nationally. They've got a number of impact fund vehicles, but it's a very small organization. Call it, 20 to 40 people out there in LA. And so when they launched this fund, I mean, it was always intended to be a very small, intimate group of people with very similar personalities, and really wanted to build a strong kind of family culture of our organization. And so I think a lot of our partners really appreciate that. And then to kind of speak on other partners, I mean, our investors are, as we started the fund, were primarily banks looking to get CRA credits. So part of what SDS had done is that they had managed new market tax credit allocations. They had done, back office for CDFIs and different groups. So they had relationships with a lot of these banks managing kind of CRA investments on their behalf. And that's the Community Reinvestment Act. We have a lot of bank partners. And the interesting thing about having bank partners is, if you've ever met a banker, they're great at relationships. And because they're typically handling the debt side of transactions or just, handling debt in general, they've got a lot of great development contacts or sponsor contacts that they are always sending our way, which is great. And then we do the same, right? So there may be a deal that's not a great fit for us. Maybe it's a true market rate multifamily deal. And we say, hey, you're in Houston. We've got 3 bank investors that we'd like to introduce you to that may be interested in providing the debt for that project. We can't do the equity because it doesn't fit our box, but we can certainly make that introduction. And I think that's been really important. And, we're the exact same way, when you mentioned technology, so we started off very old school, everything in Excel, everything manual. And I won't say we were hesitant to bring on different forms of technology, but it was really finding the right fit. And so now, we've got a partner that helps us with initial, kind of upfront underwriting and vetting of deals. We're actually onboarding Appfolio right now for their asset management and investment management platform. We're very, diligent in how we select these technologies and these platforms that we're going to work with, because we're such a small, nimble firm. We don't have the resources or the time, frankly, to be changing all these things over and over again. And it's the same at the deal level. When we fund a great project with a great sponsor, have a great relationship with them, they're always coming back to us with their next project. And I'd say 99 times out of 100, we're saying, absolutely, we know what we're going to get with you. You know what you're going to get with us. We love the deal, love working with you guys. Let's do it again.
In the current environment, I'm seeing a lot of pain, right, from a lot of investors that have purchased assets with variable interest rates. And then, as the rates went up like significantly for the past couple of years, they're starting to come down a little bit. Do you see a trend of receiverships happening within the next 12 to 18 months? How extensive would that be percentage-wise? Is it going to be like something massive, a little bit, close to nothing, somewhere in between? What do you see?
Yeah, it's a great question. I mean, I feel like we've been hearing about this wall of maturities for 2 years now. And I know, the last probably 12, 18 months, we've been talking about pretend and extend a little bit more. I will say that folks are getting a little bit more optimistic. Finally got our first round of rate cuts, which was great, but obviously hasn't translated to a positive impact on the 10-year, which has been a little bit of a stressful situation for us. But, I will say we have seen a lot of recap opportunities on the fund. So whether that is a group that developed a project that has a loan maturity coming up. They're just behind the curve on lease up and stabilization, and they're trying to recap out a pref partner. We've seen a lot of things like that. We've seen a lot of groups buying deals from groups because, they're kind of underwater on the mortgage. We haven't seen, I don't think we've seen the level of distress, though, that we necessarily thought we were going to see. And I think from our standpoint, specifically the place in the market or the segment of the market that our funds play in, the distress is more, I would say it's more driven by some governmental factors than it is from the interest rate climate or the overall market climate. And so, I think from our standpoint, what we see, we typically play in the anywhere from 60 to 120% AMI space. And so the distress levels that we're seeing have more to do with collection loss and things like that. Places like Dallas and Atlanta that enacted, eviction moratoriums, and people just decided not to pay rent. And then when those eviction moratoriums expired, you had landlords that were lining up at the courthouse to file evictions, and the backlog just got so big that the government couldn't keep up with it. And so those are some of the challenges we're seeing, and trying to siphon through the list of deals where a sponsor is saying, hey, collections are only 60% right now, but if we get them up to 80 or 90, then this deal becomes a home run. Those are more the opportunities that we see on a day-to-day basis, I would say. So as far as predicting receiverships and foreclosures and things like that, I don't necessarily buy into the fact that there's going to be a ton of that outside of major markets where you've got just a ton of office supply or a ton of high-end multifamily supply, just because I don't see that many deals in that space on a day-to-day basis.
Yeah, that's some interesting insight. I'm hearing similar things to what you said. I think everyone has a unique perspective, and I'd love to get your thoughts around obviously the construction side, because the government planned that, right? They'll just build more. It's the obvious answer from an outsider. I want to get your take, maybe if you can describe a little bit about how you look at construction, whether it's of new properties or redevelopment of existing or adaptive reuse, and kind of your thesis around that, and maybe around what you're seeing in the cycle right now, budgets, et cetera.
Yeah, would love to. I think a lot. So over the last, 12, 18 months, I think a lot of the focus has been on that bid-ask spread on existing properties, right? Sellers have a certain number in mind, a lot to do with their debt and where they need to sell the property at to be profitable. And then where buyers are willing to pay when they know they're going to have to place new high interest rate debt on the property, even if it's just for a short term. And so over the last 12 to 18 months, I think some of the best deals that we have seen have been new construction deals where contractors are getting pretty creative in how to make deals work. We work with a group, a big contractor out of Florida that has a prototype development plan where they built out kind of, think about single family spec homes and how, they just rinse and repeat the same unit types. They'll have 4 or 5 different unit types, and they just come in different color palettes in the neighborhood. It's very similar to that. It's not modular. It's not prefabricated. It's just kind of this master set of plans and they do so much volume that all their subs travel with them nationally, and they're able to deliver at an incredibly attractive cost. We've done 3 with this group. We just wrapped up construction, call it 8 months ago, on the second project. And they actually came in like $1.1 million under budget and under delivery expectations, like ahead of schedule. And so we're seeing creative things like that. I've seen things on LinkedIn about other contractors and architects doing the same type of thing. more of our compelling investment opportunities have frankly come on the new development side. With that being said, I mean, talking about the government side of things, we do a lot in Texas. And in Texas, they've got the HFC and PFC programs where you partner with a local housing authority adjacent group, and you have a certain number of units set aside as affordable. And that housing authority or trust or whatever type of group it is gets to participate in the ownership of the deal. In exchange, you give affordable units for a long period of time, and you get a property tax abatement, you get a sales tax abatement on materials. It's a really accretive way to create more affordable housing stock. And then we're seeing similar things. I mean, Florida has the Live Local Act. In North and South Carolina, they've got a very similar program, but it's I'd say it's geared more towards value add acquisition rehab, but it can be used for ground up construction. And so we're seeing really compelling opportunities where governments are stepping in and creating proper incentive programs, because I think people have finally realized that, yeah, you can say developers are greedy all you want, but if there's no economic incentive to do a deal, a developer's never going to be able to raise the capital to create more housing supply. And frankly, you look at low-income housing tax credit deals, those developers put in very little capital and get a lot of fees. And that program has worked really well. But what we're missing is kind of that workforce middle-income housing space. And then last thing you asked about was the adaptive reuse. We've definitely done some of that in the past. I think there are certain states where it's incredibly attractive. Where there's no state income taxes, it's more difficult to do those programs. So Texas, Tennessee, Florida, where you get less tax credits to do those projects, it's more difficult. But in the Carolinas, you also get like abandoned building credits or meal credits and things like that, where they're doing a really good job of incentivizing developers to take some of these really cool old buildings and turn them into housing. But it does cost a lot of money, and you have window costs, for instance, are insane because they basically need to look exactly like the windows during the property's kind of what they call, I think, the era of significance. And so for us, we see enough deal volume that I think we probably won't be looking at historic tax credit and adaptive reuse deals anytime soon. But I do think it is a good solution.
And now a word from Dean Fungawing, founder and CEO, Kairos.
So we look at freeze protection packages. We're looking at both shutoff valves that are rated by NFPA. I believe we're one of the only ones in the country that have this solution right now. And it is specifically designed for fire suppression systems. And then you've got not only leak detection in the fire protection package, but you also have the temperature monitoring. So you can see the ambient temperature, you can see pipe temperatures. You can then use this data to avoid having pipes bust in the middle of winter you have these cold snaps. What you're going to see in this country is that more and more of the climate, as that polar vortex pushes further south, you're going to see more and more extreme cold weather in the wintertime in Texas, in Georgia, in northern Florida. You're going to see more and more cold weather. It's going to get normal. And if you're not prepared with a solution, you're going to be surprised by this. You will have large insurance claims. You'll have residents that are going to have to get kicked out in the middle of the night when it gets really cold. This is a problem. Our system is also designed to notify your local fire department to let them know, hey, we've detected a freeze condition. We're going on fire watch, so that you're in compliance with local safety regulations. You can notify the alarm company in case you need to bypass the flow switch. All of this can be put together in a package that allows you to provide protection.
You mentioned earlier being the lowest person on the totem pole. You made quite an improvement since. I'd like for you to share with those that are tempted to start a career in real estate. And actually, I had a young person that reached out to me just a couple of days ago asking for advice. Obviously, in investments, that's not I've been in operation for 20 years. But what are some top pieces of advice that you have for someone that's fresh, that wants to start like you started a while back? What are some things that you learn and you would like to share with them to help them, maybe make this experience at least a little bit less painful, I should say, or learning the hard way only?
I think one good piece of advice is find a shop where you're going to learn a lot of things, and then figure out what you're good at or what you love, and then kind of go from there and try to specialize there. I think places like brokerage shops, for instance, where you're basically going to drink from a fire hose for your first few years, but you're going to see a lot of stuff. You're going to learn how to prepare offering memorandums, things like that. You're going to have to prepare stuff that any institutional group is going to want to see. I think if I were starting out today, that's probably the route that I would go. But if you know you want to be on the finance side, you know you want to go into private equity or something like that, or even development, frankly, places like a Trimont, for instance, where you're still getting the same exposure, seeing a ton of assets, seeing different markets, working with different development shops, but then kind of managing, like for instance, on construction projects, I oversaw the draw process. So I'd get the full draw workbook from the general contractor, the draw request, kind of have to go through, check all the boxes, make sure all the backup was there, read the construction monitoring reports, understand what was actually being done and making sure it tied out to what was being submitted in the draw package, then putting together the funding request for the lender or for the equity investor, things like that. All those things are pieces of the industry that you really, if you're in development or if you're in, I don't know, if you're a sponsor, maybe you're not even working on those things, right? Say you're an acquisitions guy, you bring in the deal and then you hand it off to your asset manager to handle. I think when you're young, being able to be at a shop where you see and touch a lot of different things and really understand different capital structures, who the different lenders are in the market, who the different equity investors are, in a market. I think all of that is really important and really helped me build up a network of connections that, I could leverage now that I'm in an originations role to kind of set me up for, call it the next 10 years.
You talked about the different types of states and markets and challenges from a federal level. I kind of love to hear from you, maybe something that excites you. Like obviously we're building housing for humans. We're managing this housing for humans and for people. So is there something that you spaces and envision what it's going to look like in a year or 2 years, 3 years? Or are you more like, I'm more practical, like I like the suburbs and I don't like so much of the city and doing the work there. It's more suburban, more family style. Like, do you have like a preference?
That's a great question. I will say it is typically easier for us to do stuff out in the suburbs. I think the growth in this housing sector and what we're doing in the workforce and affordable space in general is very exciting. I think a lot of people spend a lot of times on the two other extremes of multifamily housing. You've got your urban infill core class A stuff that you're kind of targeting upper income earners. Everybody that lives there makes six figures, right? And then you've got your low income housing tax credit deals or your Section 8 deals. I think what's really cool for us is when we go to a market and you say, we've got a deal, for instance, out in Ridgeville, South Carolina, and you look there and people say, well, what is Ridgeville? But when our partner brought us this deal, we looked at it and said, man, there's a 2 million square foot Volvo plant there where they're building all the XC90s. Polestar is going to start, this back then, Polestar was going to start building cars there. And then you've got this massive industrial park that the state utility company has owned and developed. There's tons of jobs coming out in this area, and there's no housing at all, not workforce housing. There's no housing. You had to drive 15 to 20 minutes away to be near any housing. And our partner brought us a great site. There was a wetlands mitigation plan, and they said, hey, we want to build 240 units here. We think there's a need. And we loved it. And I think the more you see the industrial sector grow, you see a lot of these suburban kind of bedroom communities, the major MSAs that are off major arterials, where there's just not enough housing stock. And those are all markets that we get really excited to build in because we know there's going to be thousands and thousands of jobs coming to those areas. And those people are going to need places to live, and we can deliver that.
As an investor that actually does all the deals third party, with third party managers, various ones, what are the things that keep you up at night, knowing that it's not you directly involved, but it's a third party management company agent that manages for you?
A lot of what we do has a heavy lease up component, right? And so whether that's new construction or kind of a heavy value add kind of preservation of affordable housing, having the right group to and the right people on site to lease up these properties is of utmost importance. We've had situations where, we would see the 60 to 90-day forecast be, you know, 20 points above where our current occupancy was, our current physical occupancy. And we'd say, great, they're doing a great job leasing these units. And then that would never translate. And it would never translate to like physical occupancy. And, our partners, fortunately, in that situation, our partners were really on it and dug in and found out that there was some improprieties there. And basically they were, our property manager, our on-site property manager was treating people who had signed applications as new leases, even though they didn't pass background or credit checks or whatever. And, that was a challenge that we faced. But then on the flip side, for our more kind of stabilized assets, I know I mentioned the eviction moratorium, and obviously we're an impact fund and our goal is never to evict tenants. Even when we acquire existing properties and part of the business plan is to renovate and ultimately drive rents, we're still never trying to push tenants out. We're trying to keep our rents affordable to those kind of in the 60 to 80% AMI space. But we have had situations where either we've had bad actors who have brought crime or things to properties, or habitual non-payers, right? That, were way, way, way behind on rent, had huge balances. And, having a property manager that really knows this segment of, the housing market and really understands the ways to, deal with tenants and get the right people on payment plans, right? Get people caught up. We have a property in Atlanta that, it's only 40 units, but at one point we had $120,000 in collections, and we didn't have any units that cost more than $1,000 a month. There were a couple of tenants who, they were like, I do not want to leave. I lost my job because of COVID. I'm trying to get caught up. They had made significant strides, and we told our property manager, hey, you know what? We want to thank that tenant, because that could have been a unit that we had to renovate, spend a lot of money on to get caught up. Let's waive the last 3 months of their collections. Tell them that, hey, it's a gift from ownership. You've done a great job getting caught up. But we had a property manager there who knew every tenant and knew every tenant's situation and knew, okay, here's the folks that are never going to pay us, and here's the folks that really want to be here, and they're doing their best. And I think that's really important to us. And it's something that when we pitch a deal to investment committee, we really dive into the property management company and who the regional is going to be, and if the existing staff, if it's an acquisition, are going to stay on board and things like that. So that's a really big key for us as we look at our investment portfolio.
There's always bad actors out there, right, Tyler? And
unfortunately,
and on the customer side. But I love hearing what you're saying. I always, something I try to teach my kids is always to assume positive intent, right?
Yeah.
But there can be bad ones, especially being in Atlanta and Georgia and the South. Obviously the devastation that has affected Florida, 2 hurricanes in 1 week, right? In fact, electricity is still off. I just drove by today. I'm on the way back to Atlanta, and we probably saw over 800 trees along the freeways down, uprooted. So I'm kind of curious, what your thoughts are on the shifts, not only from demand from workforce, affordable housing, even college shifts, but even now possible trends. Are you looking at trends of people moving because of weather events?
Yeah, I mean, I would have to think so. I know Florida's seen incredible population growth over the last few years, particularly since the pandemic. Obviously, lifestyle changes take people there. It's tough. I mean, Florida has a very progressive government, very pro-business, pro-growth. I think a lot of people like the politics or kind of the lack hands-on government. They moved from California or New York or Illinois, places like that. They like being in places like Florida, but I think just like California, I mean, with wildfires and things like that, I mean, there's definitely a lot of climate and environmental risk being in Florida. It's already really tough for us, before these two hurricanes to do deals in Florida, just with the cost of land. Obviously, you're on a peninsula, right? So land availability is extremely limited. It costs a lot, and then it costs a lot to build there because of climate risk related to hurricanes, wind, things like that. So for a deal that I could do for call it $250,000 a door in Georgia, it probably costs $350,000 to $400,000 a door in Florida. And then pile on that now the insurance markets and the number of insurers that are leaving Florida and what that does to premiums. It's made it really difficult. I mean, we've seen a couple in select kind of smaller markets that we really like. We've got a deal in Flagler Beach, Florida, which is between St. Augustine and Daytona. Great deal. We've been very fortunate that we haven't been impacted by any hurricanes yet, although that town was, I think 2 years ago while we were under construction, hit by a hurricane, the one that took out part of A1A just north of Daytona. But we were far enough away that we were a little bit insulated from that. But I do think you're probably going to see some population trends. And I know that we've even heard from some of our institutional investors that they're basically not interested in Florida going forward. So I think we'll definitely see that, which is troubling because you think about all of the industry there with the port and all of the industrial along I-75 and the I-10 and I-4 corridors. And those people have to have a place to live. And whenever housing supply is lost, you've got to make it up somehow. So I think it's going to be really interesting over the next couple of years to see how investments in Florida change.
You mentioned earlier government intervention, how that affects businesses. Besides, I guess the obvious things that probably that everybody knows, whether it's an eviction moratorium or rent control or rent caps. What are some things that you look for, positive or negative, when you're looking to invest, to deploy some funds, some capital to purchase a deal or to actually start from the ground up a deal? What are some things that are appealing to you, make you say, we'll sign off here because this is a great deal?
Yeah, absolutely. So from a government perspective, I think tax abatement programs are probably the biggest. I mean, when we look at a deal, your two largest expenses right now are taxes and insurance. You can control top line growth to some extent, right? Especially in our space, right? We're typically a cost leader in the markets that we play in just by the nature of being workforce affordable housing. So whenever we're kind of limited on the rents that we're charging and we're kind of the low cost provider in a market, what you're really focused on is your expense side, and taxes and insurance are the biggest. So insurance we can't control, right? Taxes, I think, are the one place that the government can step in and create positive incentives. And obviously there's a give and take there because you need tax revenue for infrastructure projects and things like that everybody cares about whenever they move to an area, right? Think about West Midtown, for instance, right? You've got a ton of apartments over there in Atlanta, and then the roads are awful and there's potholes everywhere. And so, there's give and take. But I think what we see, again, specifically in markets like Texas or South Carolina is, we can build projects very affordably, or at least very viably whenever the property tax piece is out of the equation. But some other things that we look for outside of the government piece, we're in the South, so most markets that we're in, I'd say outside of the state of Mississippi and most of Louisiana, are seeing a lot of population growth. Texas, Florida, South Carolina, and Georgia have been kind of the leaders in that, and Tennessee over the last few years. So the other statistic that we look at in terms or side by side with population growth is the cost burden on renters. And so when you see markets, we all know the Florida markets like Miami, Orlando, Tampa, right? But you could also look at Atlanta. Nearly 50% of renters in Atlanta are paying more than 30% of their income towards rent. It's the same in like Charlotte, Raleigh, Nashville, even markets like Chattanooga and Birmingham. And so when we go to these communities, the projects that excite us the most are, say, hey, I'm in the suburbs of Atlanta, even like a Cartersville, where there's a ton of new industrial supply, like I mentioned earlier. It's a very cost burdened market in terms of the MSA. There's a ton of new population growth, new industry is coming here. You're in a pro growth business state. You're pretty, like, historically pretty climate of risk averse. Obviously we have tornadoes and stuff, but you don't necessarily have stuff like hurricanes that typically come through Atlanta or Charlotte. Those are the markets that we really like. And when you layer on top of that, state level property tax exemptions and things like that, I think it really creates an opportunity to really build a lot of high quality, diverse housing.
That's great. And as I think about development and management is so local, state, but also national government. And we're especially seeing that right now with some of the discussions going on in other states, and they're spreading. I want to get your thoughts on the impact you hope to make on the industry and continue to make in your career. But number two, how do you think about mentorship and networking? Are you active in ULI or NAA or NMHC, or is it more national or local level for you?
Yeah, that's a good question. So we're definitely active in ULI. We're also members of different organizations like AHF, the Affordable Housing Finance Group, a lot of other local specific groups in our footprint that are focused on, housing and commercial real estate in kind of the markets that we focus on. But on the mentorship side, I mean, obviously we're an impact fund. And I think, one of the things that we talk about that I think that's a little bit unique about us compared to other groups is a very large portion, a vast majority of our investment are in Black and Brown communities. We're typically creating very diverse housing in those communities, but where we think we could do better at is that, and this is still a pretty good number historically for our industry, but about a little over a quarter of our investments have been with minority and female developers. And we're definitely make a targeted effort to work with more diverse developers. But kind of the next step of that is when you look at the private equity industry in general, 90% of private equity executives look like I do. They're white males. And so, as we look to bring on interns and full-time hires, we're really trying to make a concerted effort to work directly with historically Black colleges and universities and bring on diverse interns and diverse full-time staff, because I think it's something that is so, I don't want to say rare in our industry, but it's something that we as a private equity industry and real estate private equity, probably even more so, have been very poor at historically. And so, we want to make sure that, not only are we building in diverse communities, but that we're building up the people in those communities and teaching young people in those communities about careers in real estate. And so I think that's kind of our next thing. And one of the things that we'd like to teach, the things that we've learned, to more diverse groups of people so that then they can start the next impactful private equity fund. And so that we're not just on an island, here with other folks that look like us, but that we can have diverse points of view. I think that's a good thing to this industry and something we're definitely striving for.
Tyler, looking ahead, 2025, 2026, how do you see the landscape of multifamily investment and development? What do you see the top trends to be, or what do you think they're going to be?
I think 2025 is probably going to be a good year. It'll be interesting to see what the next round of rate cuts and the next round of projections look like. I think from our standpoint, we're not expecting or hoping for, the rates that we've had during this last cycle of sub 3% on multifamily debt, agency debt. I think we're trying to look at deals that are refinance at a somewhere in the fives on the debt terms is palatable, because that's closer to the long-term historical agency cost of debt. And I think we'll get there. I do. I don't know if that's the next 12 months or the next 24 months. I'm not an economist by any means, but I do think there are some trends. I think, we've seen in this election cycle, there's been a lot of talk on both sides about affordable housing being a priority. I think, both parties now have a base that really understands and needs affordable housing, which is a major shift in recent years. It's definitely not something that's been talked about on both sides of the aisle for a long time. I know President Biden at one point was talking about proposing a middle income housing tax credit, very similar to the LIHTC program. I don't have a ton of faith that that's something that will get done, just because getting broad support for a new major, spending, bucket, I think is going to be tough. But I do think there will be some positive momentum in the affordable housing sector. I'm optimistic about that. As far as markets, it's going to be really interesting to see how the South continues to hold up through the next, I'd even call it 4 years. I mean, we've seen a lot of population growth over this last 4 to 5 year cycle of people moving out of California and, out of New York. But obviously, I mean, one of the things that we see is typically those people that move from those places to the South, they still have a certain mindset, a certain mentality, and they move to a new place. And I think they expect everybody to think the way that they do. And there's a major culture shift that happens, or culture shock even. And so to see, how long the demographic or population growth continues to flow towards the South, I think will be interesting, because obviously Florida is not California. Texas is not California, and Florida is not New York. So it'll be interesting to see if those trends continue, maybe at a slower pace, or what happens. But I do think, we're all very fortunate to be where we are. We've got a pro-growth environment in the South, and I think the fact that housing is on the minds of everybody nationally is a good thing. I think we're going to get more supply. I think 2025 is going to be a down year for supply, but rents will come back. So I'm optimistic.
Few points. I don't know if you're trying to tell me to go back to California, but I'm not leaving. I love it here, man.
I'm not.
It's great. I'm just kidding, but I've become a huge advocate for Florida and Georgia now, living in Atlanta. I got to say, I think to your point, it's pretty incredible, because I was just talking over the last couple of days with some friends who live in California and developers in California, and it is so hard, and rents and home prices just continue to skyrocket, where at least in Georgia, you can still build. You can still continue to build. Florida, you can still continue to build, especially in Jacksonville and places like that. Your point, even if it is a little more expensive to build at $250,000 to $350,000 a unit, it's not $500,000 to $900,000 a unit. I think your point, but I do want to ask you too. This has been so great, and thanks for spending the time with us and opening up. I'd love to know how we or our audience can help you and your team.
Yeah, absolutely. Well, we're closed-end fund structure, so we still got plenty of dry powder that we're looking to deploy over the next, call it 12, 18 months out of our second fund vehicle. So we're excited about that. Again, we're kind of looking for that workforce, affordable housing type opportunity. Our footprint is Texas to North Carolina down to Florida. We're very active. We typically cut checks in the $10 to $20 million range. So if you've got a need on your project for equity, definitely feel free to reach out to myself. We're going to be launching our next fund by the end of this year. So we're excited about that. Be at a number of conferences through the end of this year. So please, if you're listening and you happen to be going to the IMN Family Office Conference down in Miami later this month, or to AHF Live in Chicago in November, please reach out. I'll definitely be at those. And don't hesitate to reach out, ask any questions. And, if there's anybody out there that's listening that's looking for an internship or just kind of general mentorship, I'm happy to provide that as well.
Taylor, it's been amazing to have you on today with us to share your thoughts. Take time out of your busy day. It's incredibly powerful to have the angle of an investor and developer, because typically our guests are executives on our operations side. So this has been great. What are some things that you'd like to share with our audience in closing?
Yeah, it's a good question. I think again, it just kind of cycles back to the things that we've heard. I mean, affordable and workforce housing is a really great investment opportunity. We don't have enough in this country. We don't have enough in the South. We can't keep up with demand, general population growth as it is. We really need developers to step up and play in this space, and it takes getting creative. There's a lot of great lenders out there that really focus on this space where you can get really competitive interest rates. So I'd say, be diligent, but if you build it, they will come. From Field of Dreams, I mean, there is just not enough supply to keep up with the demand for this type of housing in the South. And so I'd say to anybody out there that, is looking to kind of move into development or is in development, or maybe they're in market rate housing and they're seeing concessions skyrocket across their portfolio, there is a segment of the market that you can play in where you're not going to deal with those issues. There's certainly other challenges that we face in this space, but I think affordable and workforce housing is an incredibly compelling investment opportunity, and we need more people to come into this segment of the market if we're ever going to get close to achieving, a kind of a supply and demand balance. I'd encourage you to get out there, look for sites. It doesn't have to be, if you're an Atlanta developer, go to Cartersville. If you're a Nashville developer, go to Murfreesboro. You don't have to build infill products, for people to come. I mean, people will drive. I mean, it's unfortunate. We'd love to build product next to a MARTA station or next to a bus stop everywhere we can. We need housing everywhere.
Thank you so much, Tyler, for spending your time with us. It's been an incredible conversation.
Thanks again. And it's been amazing having you today. I want to thank all of you that joined us today live. I want to thank our friends and sponsors from Kairos and Coastal Training Contractors. We will see you in a couple of weeks next week. Chris and I are taking off. We're going to be at UpTech. So if you're UpTech, just look for us, text us, message us. We'd love to meet. We will be back on the 31st of October for another episode. Take care, y'all.